Pay off debt or invest in real estate? We're going to talk the Dave Ramsey approach to paying off debt and investing. Hey everyone, I'm Clayton Morris. Nice to see all of you on today's show. This is the channel where we invite you to come in and build financial intelligence and ultimately financial freedom. It's also a place of positivity. We want this to be a place where you can come here with whatever stage of investing you're in and not feel guilty or ashamed that someone's going to pick on you or that you are not worthy of this information. We have people who are watching this show from all manner of different strategies and in their life. Some of them have 10 properties, 20 properties, some have none, some have a lot of debt. That's okay. This is a positive place. So if you want to bring negativity, send it someplace else. It's not here on this channel. All right, let's talk about paying off debt and whether or not you should pay off debt first or invest. Now, I know it's a popular trope out there to talk about paying off debt. It's the sort of Dave Ramsey approach to this. Now, I'm not going to step on Dave Ramsey. I'm not going to crap on him in any kind of way. I'm friends with Dave, actually. I've had him on the show a number of times. And look, he has a very good strategy for helping you to get out of debt and pay off debt. But what he doesn't say is, of course, that there's other ways, and the only other way to build wealth, in my opinion, is with debt. So how do these two square, right? If you're dealing with debt, how can you also build wealth using debt? Well, let's talk about that. So there are four main areas I want to touch on before we kind of dive a little bit deeper into these. Number one, do you have other investment opportunities? So if you're saddled right now with $60,000, $70,000 in debt, do you have something else that's available to you that you can go after? And you want to think about whether or not there's even something available to you. If you're sitting there right now with $75,000 in debt, my approach would be to go after the sort of snowball method that Dave Ramsey talks about. It's exactly how I was able to get out of debt. Was able to take, I had like 5 or 6 credit cards, and I'm able to look at those different credit cards and say, okay, the one that had the lowest balance. Now that might be counterintuitive because maybe that even has a lower interest rate. It doesn't matter. We're creatures. So logic would tell you, look, man, you should go after the one that has the highest interest rate and the highest amount of debt. No. What works for humans is because we like to see progress. So if you've got a credit card there that's sitting there that has, $1,000 and you have another one that has $8,000, go after the lowest hanging fruit and start just slicing and dicing that debt. And you'll pretty soon start to get out of that high interest credit card debt that you might have. Or some other high interest loans that you're carrying that is really a liability. And what we're talking about here is getting rid of these liabilities. Now, while you're doing that, do you also have something available to you in the form of an investment? Maybe you have the opportunity to buy your first rental property. Then what you can do is, yes, still focus your attention on paying off this debt, but also maybe leveraging a loan in order to start to buy a piece of rental property or another performing asset. Perhaps it's even a business. You see, what we're doing is these over here are not putting money in your pocket every month. But owning a business or a performing asset like a piece of rental property is now starting to put cash in your pocket. Yes, you're using somebody else's money to do it. OPM, other people's money. No wealthy person in this country has been built without the help of other people's money, unless daddy handed you a big pile of money after he passed away and that's how you made your money. No. In order to build wealth, you need to do it with the help of other people's money. Bottom line. And that's really where Dave Ramsey falls flat in this, is that he might just tell you to put some money in some mutual funds or things like that, but that's not how you build true wealth. That's not how you start to build performing assets that put cash flow in your pocket every month. So you want to analyze your situation. Again, this is a deeply personal question. There's not a one-size-fits-all approach here. But one, do you have another investment opportunity? That's something to think about. Number two in this, what is your tolerance for this debt? So can you pay down this debt? My father-in-law likes to say he absolutely would not be able to run his company without debt. And he has a higher tolerance for debt than some other people. So if you're at 30 to 40% debt, that's a good place to be. You're using the bank's money in order to buy these assets that you can now depreciate on your taxes. You see, you have to have some level of tolerance for debt. If you don't have a tolerance for debt and you're terrified of it, and I know people that are. My dad is like kind of terrified of debt. He just hates having debt of any kind on credit cards, that's great. But he has also no plan for passive income. He has no plan to go out and find performing assets. So it has to be a deeply personal question. You know, what is your tolerance for debt? So if you don't have a tolerance for debt and you have about $10,000 in credit card debt, then get those guns out and go after that credit card debt like a howitzer. And then you can start to have these discussions about buying performing assets. Again, it's a deeply personal thing. I can't change your psychology about this. But I just want you to see the difference between these two debt structures. Number 3 really is, what is your time horizon? So if you are in your 20s, great, you've got so much time to play with this. If you're in your 70s and you're in this massive amount of credit card debt, well, that's a different time horizon for you. Now you really need to start thinking about, well, what am I going to do about this credit card? I don't want to pass this on to my family in any kind of way. Can I start to figure out a way to maybe convert some of the things that I've been holding on to like a hoarder for most of my life? Can I sell off a bunch of the stuff that I've been sitting on for 60 years that I don't need? This old car that I like to fix up, can I use that, pay that off, sell that to pay off some of this debt? What is your time horizon? So if you're in your 20s, I really don't want you to go into massive debt. I don't want you to go into student loan debt. I don't want you to go get all these credit cards. By the way, I have a video series coming out where I'm talking about this, and I just don't think that college is a good investment right now. And by the way, I just published a blog post on our website. Go check it out at morrisinvest.com/blog. We just wrote a whole long story about, is college a good investment? And I'd love to hear your thoughts on that, but I really don't believe it is. So if you're in your 20s, do you want to go massively into debt for a college degree you're never going to use? Credit card debt for stuff that you didn't need and you are now saddled with. So again, what is your time horizon? And number 4 on this list really is, what is your required monthly income to live? And I want you to really analyze that. So this is what we go through in our Financial Freedom Academy. I'd love for you to join our Financial Freedom Academy as well, because we really want you to help understanding your expenses. So do you even need half the crap that you're saddled with? You have all of this debt, you have money going out on ridiculous things that you're spending money on, whether it's cable bills or multiple video streaming services. We're getting so saddled with subscriptions right now, right? We've got Netflix, we've got Hulu, we've got Apple News now that we're paying for. We've got, where can you cut this stuff and start to be really strategic about the things that you're being saddled with? So what is your required monthly income then to live? Well, that might change if you start to get rid of some of this crap in your life. So those are my 4 main areas, but I want to go deeper now, and I want to talk about how most businesses don't really think of this as an either or. That's the problem here, right? Is that in order to build, you have to do both simultaneously. You have to pay down debt, but you also have to acquire good debt. So I'm going to give you a perfect example. Today, for instance, I just got a loan approval. It just came through today from a bank that we use on a refinance on one of our properties. So we have a property that we built. It's a new construction house, and we're refinancing it right now. We're pulling the money out of it that we put into it using a bank, other people's money. Now, at the same time, I've got some credit card debt sitting over here, okay? I just bought a new computer. I've got some other things, but that's business debt on the business credit card. So now I'm going to use rental income that's coming in from the performing assets to pay this off. And I carry a 0 balance every month. But I'm getting airline points every time I use that card because I know how the money will flow. And now I travel for free all the time. I never pay for travel because of that. So that's how most businesses should be operating. But a lot of businesses will go sort of wildly into debt and sort of sit there with this debt, not building up the performing asset cash flow side of the business. So think of it like a teeter-totter. The kids at the park when you go to the playground, think of it like a teeter-totter approach. Can you plan wealth at the same time that you're reducing your liabilities? Can you plan for this? And the answer is you absolutely can. Now, the Dave Ramsey approach to this, love him, is pay down your debt, but really have no plan for like long-term wealth building. Again, we've read his books. I've read his books. He's a great guy. But his plan about just buying some mutual funds. I mean, look what happened to the stock market. 700-point drop the other day. If your future is tied to the variable of a stock market, God forbid, right? Look at 401k. The 401k historically was never meant to be a solo way of retiring. In fact, the founder of the 401k, he in an interview just recently talked about the 401k was only ever meant to supplement pensions. The idea was that you would have a pension as well as a 401k plan. Guess what? Pensions are all but gone, right? And 401k plans are all but gone. Matching from companies, all but gone. So as a solo way of investing, it makes 0 sense. So I have some videos and podcasts coming out about the 401k, and I'm going to punch the 401k because I honestly believe it's a terrible vehicle, and people are being lied to about how it operates. But really, that's kind of the Dave Ramsey approach, which is put money in these retirement accounts and just kind of set it and forget it, right? You pay a money manager, you're paying all these fees, that's okay, because you're not smart enough to handle your own finances, so just let somebody else deal with it, and you kind of just ride it out, stock market. Well, what happens if you're nearing retirement age and the stock market plummets again like it did in 2007, and you've lost now 30 years worth of your savings? That happened, right? And then people will argue 10 years later, well, now it's bounced back. I waited it out, and now it bounced back. Great, so you lost a whole decade of growth? A whole decade. People have called it the lost decade. So that's the argument you'll hear from people. Well, I just let it go, and yeah, now my 401k bounced back. It was rough in 2007, but now it's back. Yeah, to where it was a decade ago. Now imagine in that amount of time you could own 30 rental properties that are monthly producing cash flow for you, that you're also depreciating on your taxes. You're accelerating this depreciation, and then you're building up this long-term asset pool that's going to take care of you for the rest of your life. I don't want all of my eggs in a stock market basket. And I'm not saying to not have some aggressive stocks that you can play with in your portfolio, but to have all of your eggs in that basket, that's scary as hell. That's really terrifying. Don't you think? I mean, I would be. I saw it firsthand. I remember people at my place of employment 10 years ago kind of crying because they lost like everything. And some of them were at retirement age. They don't have 10 years to wait for it to bounce back. So, I'm sorry, a little sidebar tangent, but it just makes me upset when people use that argument. So, paying down these expensive liabilities, that's a goal, right? We absolutely want to pay down these expensive liabilities. Should be your first priority. Absolutely. So, I'm not arguing against that. Especially liabilities that are not attached to performing assets, okay? So, if you've got an expensive liability credit card or student loan that's not attached to any performing asset, we've got to figure out how to get after that thing, okay? We've got to turn our attention to reducing other spending in our life and going after that bad boy. There's ways to do it. You can live minimally. I want you to sort of examine the ways that you're wasting money right now. If you think about the ways in which you are wasting money, even if it was an extra $100 a month that you could pull from in order to fire at that student loan debt and accelerate that. Go after that lowest hanging fruit credit card. Cut that thing up and don't use it anymore. You know, or transfer those into a 0% interest rate credit card that you can then leverage. You know, move that debt around so you can get a harness on that. So if you've got 4 credit cards and they're all like at 22% interest, can you move that debt into a 0% for 18 months? Because there's all sorts of great business credit cards out there that will let you do that, right? If you just go to our funding tab on our website at morrisinvest.com/funding, like that's the bulk of the credit cards we use are 0% interest for 12 months, 18 months. So can you consolidate some of that debt into a 0% card for a temporary amount of time? And while it's at 0%, fire it like crazy. Pay that debt down like a howitzer. Focus your attention on getting that liability paid down. Now, I don't want you to put blinders on, and that's the only thing you focus on. Again, thinking about how you can also start to acquire performing assets. Working with a local bank to find that property, to get that new construction property like what we do at our company, and you put 20% down and be able to have that now generating $900, $1,200 a month in cash flow for you. How could that change your life? Why would you wait 30 years to pay off this debt in order to start acquiring assets? It makes no sense. This has nothing to do with this. You're using a bank's other people's money in order to build this wealth. This is a different animal. This is your liability debt, right? This is the money that you paid Chinese food for 5 years ago on your credit card in college. This is a liability. This has nothing to do with buying performing assets. So if you take nothing else away from today's show, I want you to understand there's nothing there. It's separate, totally separate. And you can do that. That's exactly what I did while I had $75,000 in debt. You can do it. It has to be, a line of focus, building performing assets. Okay, so number one has to be going after that liability debt. Number two, though, has to be building performing assets. It's a close second, okay? It's a close second to this. I don't want you to think that this is a second-class citizen over here. It's not. It's a close second. Because what's going to happen is this teeter-totter, you're going to start to see this happening. It's super exciting when it does, because now this debt starts going down, this starts going up. And then what do you do with all this additional cash flow? Guess what? You keep buying more performing assets. Because now you can accelerate that depreciation and you don't want to have to be paying taxes on that income, right? Now this is down to nothing. And now this just keeps getting built up and built up and built up. And now you're paying nothing in taxes because you're doing it like the way we teach you to do it here on the channel, which is to build financial intelligence. We want you not to have to pay anything in taxes because you're doing it legally. The government rewards you for buying assets. They reward you for buying housing and building housing for people. And they reward you in the form of tax breaks and tax benefits and depreciation. You don't get any depreciation or benefits from this over here. That's why we want to switch this teeter-totter approach. So think about it this way. Can you buy an asset that helps you pay down your existing liabilities? And the answer is yes. You could buy a business. You could buy, think about Walt from Breaking Bad. You could buy a car wash, right? You could get a loan from a bank and buy a business that now is a cash generating machine, and that cash is going to paying down this debt and getting that paid off. Or you could buy real estate, what I do, and single family homes, duplexes that perform every month, and that additional cash, whether it's $5, $6, $10, $20, $30,000 a month in cash flow, pays this off in no time. And that's how you start to do it. Again, using other people's money in order to acquire these assets. Second, can you leverage your current assets to pay down existing liabilities? Can you leverage your current assets to pay down your liabilities? Now, this is going to blow your mind. This may make some of you angry. Well, I don't care. But it's, again, trading financial products for financial products. So you've got an incredibly high, interest debt over here. And you've got $100,000 to work with in your primary residence as a home equity line of credit. Or some other way. Maybe you've got funding like we teach you on our website. If you go to morrisinvest.com/funding, maybe you get 0% interest business credit cards or something. Or a private loan somehow. All I'm saying is, do you have some other financial vehicle that you can use to pay this off? Because again, I know the idea is not favorable that you're just trading debt for debt. But when you are trading 4% debt over here for 22% debt over here, I mean, I'm sorry, is that even a question? I would much rather have the 4% debt over here than I would the 22% debt over here. Makes zero sense. Now with that 4%, whether it's a home equity line of credit or not, remember, you cannot eat equity. So you have $100,000 of equity sitting there doing nothing for you. And yet every month you're bleeding all this cash over here because of your liabilities. Well, yes, you got into debt. You have to get yourself out of it. You can't just, declare bankruptcy and see your student loan go away. That doesn't work. So you've got to get yourself out of it. Take some responsibility for this. Using a home equity line of credit, even if it's a variable rate after a number of years, it's not going to jump up to 22%. I mean, maybe it will. I can't say it won't, right? But look, we're at like 3%, 4%, 5% interest rates right now. This one's already at 22%. Would you rather live in a what if? So I want to take this debt and maybe, you got a $3,000 credit card bill over here or $5,000. Just fire it and pay it off. Get it done. And now pay this down as quickly as you can back to zero. Look, I've even written a book on how to pay off your mortgage in 5 years using this strategy. We'll have a link below. It's called How to Pay Off Your Mortgage in 5 Years, and it's a #1 Amazon bestseller right now. We're also on Audible, by the way. We teach you this process in the book. So you're using different financial products in order to help yourself, okay? So you can look at these different things to use. Can you leverage these current assets that you currently live in to pay this off? Can you even leverage your current assets to buy a true performing asset? Okay, now I know this may piss a lot of people off, and that's fine. I've done it repeatedly. And this is how I was able to get out of debt. So taking that home equity credit that you have, or even money from Fund and Grow like we teach you to do, and use that money to buy performing assets to pay this debt off. So could you with that, think about this for a second, right? If you've got $100,000 in equity, you've got an $80,000 home equity line of credit that you can use, you could probably pick up about 2, 3, even 4 rental properties with that amount of money as a down payment, leveraging other people's money. Now, what would your life look like if you had an additional $3,000, $4,000, $5,000 a month in rental income coming in every month because of that? To fire at those liabilities, right? Now, it's not coming out of your salary. You're still working your 9 to 5, right? If you're working. So that money is here. Now you're using these performing assets to kind of rainbow effect to go over to your liabilities. And you're still living, but you've also cut some expenses, so you're going down and down and down. I mean, you're just floating all boats with this strategy. When you buy a performing asset with maybe the equity in your home, remember the beautiful tax benefits of this. You're not just buying a performing asset, you're buying a tax shelter. So when you start running the numbers on, let's say you bought a new construction property, which you can. If you book a call with our team, we're building a whole bunch of great new construction properties right now. Just go to morrisinvest.com and get on the phone with us. But so if you buy a new construction property, for instance, or any property, doesn't matter, but imagine buying a new construction property with a down payment on the backs of a bank that you now can do at what's known as a cost segregation. You send in a special cost segregation CPA. We just did one last week, and holy smokes, the amount of savings. We did it on 3 of our properties. I was blown away by the cost savings that we're going to have because of this. What it does is it allows you to more quickly depreciate that asset on your taxes. I know this is high-level stuff, and I'm going to do a whole series on cost segregation, so don't worry about it. Just understand that, you know, by buying this performing asset, it's not just the cash flow. You're now being able to accelerate the amount that you're able to deduct on your taxes. So it's cash flow and the tax benefits, and now that's how you offset your W-2 income, all while paying off these liabilities over here. I mean, it's a magic formula. Not everyone knows it. The wealthy understand this. Love Dave Ramsey and love his approach to paying off debt, but you've got to build performing assets. You've got to be able to put monthly cash flow in your pocket. You see, if I spent, let's say I got, you know, $23,000 this month from my tenants in all of my properties, okay? That's $23,000 a month in cash flow coming in this month just from my properties. I'm just throwing out there hypothetically. Well, guess what? Even if I spent that all, it resets next month. Next month, $23,000 comes in again. That's the beauty of having performing assets. That's the beauty of getting rid of liabilities. So paying off this debt and investing simultaneously. Think of it like the teeter-totter approach. You have to work your numbers back and forth, back and forth. And this is what we teach you to do also in our Financial Freedom Academy at financialfreedomacademy.com. We've got a great group of people who are in there as Academy members, and this is what we teach you to do. So paying off debt and investing simultaneously. Love you, Dave Ramsey, but you need to invest also in order to build true wealth and true passive income. So thank you so much for joining us today. I hope we've brought you a little bit of financial intelligence so that you can build financial freedom.